Hello. In this video, we will discuss the basic concepts of accounting. Accounting concepts are fundamental principles that serve as the foundation for recording and reporting financial information. First, let's look at some of the most important accounting concepts. Accounting entity. This concept states that a business or organization is considered a separate entity from its owner. Therefore, financial records are prepared specifically for the entity, not for the personal use of the owner, going concern. It is assumed that the business will continue to operate indefinitely and will not be liquidated in the near future. This assumption is important for asset valuation and liabilities, accounting period. Financial information is prepared and reported for specific time periods, such as monthly, quarterly, or annually, to facilitate analysis and comparison. Accrual basis. Revenues and expenses are recorded when they are earned or incurred, not necessarily when cash is received or paid. This provides a more accurate reflection of the financial condition, monetary unit. All transactions are recorded in a single currency unit, for example, US dollars or euros, to measure and compare financial data. Consistency principle. Accounting methods should be applied consistently over time to allow comparability of financial statements. These concepts are crucial to ensure that financial reports are accurate, reliable, and useful for users such as managers, investors, and creditors. Definition of accounting. Accounting is a system or process of recording, classifying, summarizing, and presenting financial information of an entity such as a company, organization, or individual. This information is used to make economic decisions related to managing the resources of the entity. According to the American Accounting Association, AAA, accounting is the process of identifying, measuring, and communicating economic information to enable clear evaluation and decision-making by users of the information. Accounting can also be understood as the art of recording, classifying, and summarizing financial transactions expressed in monetary terms along with interpreting the results. Simply put, accounting is the language of business that describes financial activities in a structured manner, allowing stakeholders to understand the financial condition of an entity and make informed decisions. This material covers definitions from authoritative sources and can be used as a foundation for understanding accounting's role and purpose in business and organizations. Normal balance in accounting. Normal balance in accounting refers to the usual side of an account, debit or credit, where increases are recorded based on the account type. Understanding normal balance is essential to correctly record financial transactions according to the account's classification. Types of normal balances. Asset accounts. Asset accounts normally have a debit balance. Examples include cash, accounts receivable, supplies, inventory, buildings, land, and equipment. Additions to assets are recorded as debits, while reductions are credits. Liability and equity accounts. Liability and equity accounts normally have a credit balance. Examples are accounts payable, loans, owner's capital, and retained earnings. Increases are recorded as credits, decreases as debits. A debit balance here usually signals an unusual condition. Revenue accounts. Revenue accounts also have a normal credit balance. Examples include sales revenue and interest income. Increasing revenue means crediting these accounts, which increases company value. Expense accounts. Expense accounts normally carry a debit balance. Examples are wages expense, rent expense, advertising expense, and other operating costs. Expenses decrease equity and are recorded as debits. Function of normal balance. Normal balance serves as a guideline for accurate transaction recording and financial reporting. Knowing whether an account normally has a debit or credit balance helps to maintain accurate bookkeeping and produce financial statements that truly reflect the business's financial condition. Example of normal balances. Conclusion. Normal balance is the expected debit or credit position an account category usually holds. This concept helps ensure transactions are recorded properly and financial statements are accurate, facilitating sound business decisions.